So as traders, it's always in our best interest to have as much information as possible about the asset class we are trading. So in my personal case, this is the FX market. So that's why whatever the asset you are trading, it's always very important to understand why this specific asset is moving. What is actually driving the price of this certain asset? So for me, what is actually driving the price of currencies? And that's what we're going to see in this video. So yes, currencies move because of supply and demand. Currencies mainly move because of flows of buyers and sellers into the market. But what really drives currencies at the end of the day is interest rates. So as you know, in FX, we are dealing with many different fiat currencies, established currencies such as the dollar, the euro, the pound, the Aussie, the Kiwi, the Japanese yen, etc. And all this cash that is available around the world is not created equal. So we basically have each country or zone that provides this specific currency that sets and decides a certain interest rate. So what's that interest rate? It's actually very easy to understand. You know, when you put money into your certain bank, you get a certain interest on your money you put in, okay? Now, as an investor, you can put your money in any country you want, in any currency you want. However, depending on the currency, the interest rate will change. So by looking at all the different choice of currencies and what's the interest rates on them, I can decide how much I want interest and where am I going to put money. So I can put my money in Japan and get a certain interest rate. I can put my money in the US and basically decide. So obviously, as an investor, what would I be looking for? I would be looking for higher interest rates, okay? The higher the interest rate, the better, because your money is working better in that specific bank, in that specific currency, in that country. So basically, people will move cash around, and when I talk about cash, I'm actually talking about billions, okay? We'll move cash around depending on the interest rate of countries, knowing that interest rates actually change. The central bank of a certain country decides to change to update the interest rate. Now, knowing that central banks can actually change this interest rate, people will move money around depending on the future outlook of interest rates and also the risk of that specific country, okay? So that's why any decision to change interest rate in the US by the Federal Reserve, which is the central bank in the US, or the Bank of England, or the Bank of Japan, or the European Central Bank, whatever central bank decides to change interest rate will have a direct impact, and people will jump in and out of positions, in and out of currencies. So of course, as traders, these interest rate decisions offer a lot of volatility that we could be able to capitalize on, but also every single economic data you see coming out can be an indicator, can give hints on what the central bank of this specific country could be looking to do in the future. And as we know, future outlooks of interest rates will actually move the currency because people are anticipating it and moving money around to get better interests. So that's when actually having fundamental analysis knowledge comes in very useful, and you start to see things much clearer because you understand why things are moving, because you actually understand why currencies move in a certain way. To give you a very concrete example about this interest rate concept, I think it's very interesting to look at carry trading. So carry trading is when you buy or sell a certain currency pair in order to get a positive swap. So you know, when you hold the currency pair, every night you'll either have a credit or a debit in your account, okay? And this credit or debit is essentially the difference there is between the interest rates of the two currencies you're trading. So for instance, we know that in the US, currently interest rates are at 0.25%, with US dollars, of course. Now, if you look at Mexico, with the Mexican pesos, the interest rate there is 4%. So what happens here, how you can profit from the difference in interest rates, is simply by shorting dollar against the Mexican pesos. Because essentially, you are borrowing the dollars at a rate of 0.25% to buy Mexican pesos, which brings you 4% because that's the interest rate. So overall, on the period of a year, in swaps, you've received 3.75% on your money. However, you may ask, how can Mexico offer such high interest rates, so 4%? And it's simply because investing in Mexico is sort of riskier than investing in the US. If you ask me, I would rather have my money in the US than having my money in Mexico. So basically, when things are going well, it's understandable why people would be short dollar against the Mexican pesos, because they are making money every single night because of the swaps. However, obviously, if shit hits the fan and things become riskier, what are you going to do? You're going to probably move your money out of Mexico, out of the Mexican pesos, because you don't want to take that risk anymore. And what did we see during the COVID crisis? Right at the beginning, we saw the price of dollar mex, so the dollar against the Mexican pesos, rocket, simply because everyone was short dollar mex, as I explained, when things were going well. So when things are not going well, what are you doing? You're just liquidating your position, taking your money out of the Mexican pesos, and what happens? Everyone buys back dollar mex, so dollar mex literally shot up during the COVID crisis. So this is just one direct and concrete example, but to actually show you the power of understanding why currencies move, and having deep fundamental knowledge of the FX market to really give you an edge on that market. Now, concerning this subject, I'm actually very proud to announce that in the next 2 to 3 weeks, I will be releasing a completely new module about fundamental analysis, economics, finance inside of my trading program, so the Forex Pro Trader program. The link is right down below of this video, and I really explain in detail all the fundamental knowledge, fundamental concepts I've learned through trading in an institution, because I truly think that fundamental knowledge is what differentiates retail traders from institutional traders. So as I said, this module will be released in about 2 to 3 weeks. The link is down in the description. I really hope you enjoyed this video and you learned something new. If that was the case, please leave a thumbs up. If you have any questions whatsoever, please leave them down in the comments. I'll read every single comment, and you can also send me a direct message directly to Instagram, which appears just here. If you've never seen me before, my name is Elliot, and I post a video about trading, investing, finance, literally every single Sunday. So if you enjoy this type of content, make sure you subscribe to the channel. I wish you an excellent rest of your day. Peace.